Welcome back to the Deep Dive. Today we're conducting a bit of a financial investigation.
We are. We're diving into the mind of one of the world's most successful investors, Howard Marks.
Right, and his philosophy at Oaktree Capital is all about defining the risk before you even start thinking about the potential reward.
That's the perfect way to frame it. We're going to try and connect the dots on his thinking across, really, three huge areas.
Okay, what are they?
First, the tech enthusiasm, everything happening with AI. Second, the deep-seated irrationality that he believes drives market prices.
And the third?
And this might be the most critical one for right now, the huge strategic shift required by what he calls the sea change in interest rates.
So he's really a psychologist who just happens to manage money.
That's it, exactly.
Okay, let's jump right in with a topic that's dominating every conversation. Artificial intelligence. Marx is a realist here. He absolutely acknowledges the potential. But then he immediately draws this crucial line between the tech itself and whether you can profit from it.
He does. He starts with a very definitive statement. He says there is every likelihood that AI will change the world.
So he's not debating that part.
Not at all. But then he brings the hammer down. He gives this warning that I think is essential for every investor today.
Which is?
Changing the world is not enough.
That's a powerful distinction. Why isn't it enough to just change the world?
Because history has already taught us this lesson, and he draws a very direct, almost chilling parallel to the internet boom.
The late 90s.
Exactly. The internet absolutely changed the world. It created this permanent, fundamental shift in how we do everything.
No question.
Yet, he reminds us, the vast majority of the stocks that were introduced back in that 1999 tech bubble,
They went to zero.
they ended up being worthless.
So even with a genuine revolution happening, you can still lose all your money if you pick the wrong company
Or, and this is the core of his argument, you pay the wrong price.
Right. The price you pay.
That's everything. And the problem is, it's so hard to identify the actual winners who are going to capture the profits.
Marx is pretty open about that himself, isn't he?
Oh, totally. It's part of his humility. He says, look, I'm not an expert in technology. And then he says the three most important words for an investor. I don't know.
I don't know which companies will be successful.
If he can't pinpoint them, what chance do the rest of us have?
It's a fair question.
It leads him to this conclusion that there's a much less than 100% probability that investing in any given AI company or sector today will be profitable.
There's just too much uncertainty.
So much. Who actually benefits in the end? Is it the companies building the models, the ones using the tools? Or maybe it's just us, the customers, who get cheaper services.
And if the benefits spread out too widely, no single company gets those massive excess profits.
That's the risk.
So let's talk about pricing.
Yeah.
Right now, we are seeing these historic, eye-watering valuations on the big tech names. Is Marx ready to call this a bubble like he did in 2000?
Not quite. And this is interesting. He sees the valuations as high, but not crazy. He's explicitly said he has not put the bubble label on this incident. And the reason is that he does not detect that level of mania at this time.
So that psychological fever pitch isn't there yet. That feeling where investors truly believe there's no such thing as a price too high.
It's not a full-blown mania in his view, but the optimism is definitely, it's up there.
It's excessive.
Yeah, that's the word. He thinks the market's psychological timeline is just off. He says the expectation for the adoption of AI is a little too fast.
So the risk isn't necessarily an immediate crash.
No, the risk is that today's price already assumes 10 years of absolutely perfect execution and adoption.
Which leaves zero margin for error.
None.
And that really forces us to zoom out and look at the foundation of his entire philosophy.
Yes.
This core idea that it's psychology that drives markets to these extremes, whether they're, fully manic or just wildly optimistic.
This is the critical link in his whole framework. Marx insists that in the short run, the market is just a voting machine.
It's not a weighing machine.
Not in the short run. It just reflects the loudest opinions, the emotional trends of the moment. It has nothing to do with special insight or real value.
So the daily price changes we see
are almost all about changes in market psychology. If the consensus decides something is flawless, the price goes up. And it doesn't matter if it's trading at 10 times earnings or 100 times earnings.
And of course, human beings are terrible at moderation, especially when there's money on the line.
We're awful at it. Marx points to this enormous human tendency toward overreaction.
You see it everywhere.
You do. If you look at the real world, a company's actual profits, its cash flow, It tends to fluctuate between, pretty good and not so bad.
A fairly narrow band.
But in the minds of investors looking at those same companies, the perception swings from flawless to hopeless.
All the way from one pole to the other.
Exactly. And that crazy swing in perception is what makes stock prices fluctuate way, way more than their underlying value ever does.
So if the average person is driven by consensus and emotion, then the prudent investor has to do the opposite. They have to exploit that irrationality.
Through contrarianism. Marx is so clear on this. He says successful investing is not a matter of buying good things, but buying things well.
It always comes back to the price you pay.
Always.
Mm-hmm.
I mean, value without a good price is just a hope. And he uses the Nifty 50 stocks from the late 60s to hammer this point home.
These were the blue chips, right? The absolute best companies in America.
The best of the best. And investors were told there could be no price too high for them.
So what happened to the people who bought into that idea?
They lost almost all their money.
Wow.
Yeah. Because the valuation multiples got so ridiculously high that even with incredible growth from the companies, the market eventually woke up and realized that you can't justify an infinite price.
The multiple compressed.
Exactly. You own the right company, but you bought at the wrong price, and that's what destroyed the portfolios.
And that failure to wait for a good price, that seems to come from a behavioral flaw.
FOMO, the fear of missing out.
Right. It's why in the stock market, the demand curve slopes upwards. The higher the price goes, the more people seem to want in.
And Marx identifies the flip side of that greed as the absolute cardinal sin in investing.
Which is?
Selling during a market crash out of pure fear. When you panic and sell low, you turn what should have been a temporary dip into a permanent loss.
You lock it in, and then you miss the recovery.
You miss the recovery, and that's where the contrarian comes in. Prudent investors, like his firm Oaktree, they buy when those fearful investors disgorge great assets for cheap.
It takes incredible discipline, which is probably why he focuses so much on risk control.
It is Oaktree's #1 philosophical point, but his definition of risk is really different from what you learn in finance textbooks.
Right, he completely rejects the standard definition. How does he see it?
He is very clear. Volatility is not risk.
Even though that's how it's always measured. Standard deviation and all that.
Right. He says volatility is just price fluctuations. The real risk that matters is the risk of losing money for good.
Permanent loss.
Yes. And that is an intangible. You cannot quantify it in advance or after the fact. You can't put a number on it, so you have to just focus on controlling the downside.
And that focus on prudence is so important right now because, as you said at the top, we're in the middle of this massive structural shift.
But the sea change.
The sea change. Tell us about that.
He argues that the time of easy money is over. And to get how big a deal this is, you have to look at the last 40 years.
Okay.
He calls the long decline in interest rates from 1980 all the way to 2020 the most important event in the financial world in the last half-century.
Why was it so powerful?
Because falling interest rates are like a giant financial steroid. They boost growth, they lower borrowing costs, and crucially, they lower the discount rate you use to value future profit.
Which inflates the value of basically everything.
Every long-duration asset. Stocks, private equity, venture capital, real estate, it just pushed everything higher and made investing look easy.
And that period from 2009 to 2021, when rates were near zero, Marx calls that abnormally low.
And he's adamant that those rates will not be seen again in the coming decade.
So what's the new normal?
He thinks the Fed funds rate will probably settle somewhere around 3.5%. Now, that doesn't sound crazy high, but compared to zero, it's a completely different world.
And that requires a different strategy.
It demands fundamental changes in investor behavior.
So if the tide of easy money has gone out, what does that mean for portfolios?
It means that debt suddenly looks attractive again. It necessitates the return of carefully selected debt holdings to portfolios.
Why?
Because you can now get yields that are actually competitive with the stock market's long-term returns, but with less risk. He points out that high-yield bonds are paying close to 8% right now.
So you don't have to chase risky growth stocks to get a decent return anymore.
Exactly. The game has changed.
Speaking of debt, Marx recently talked about some of the blow-ups we've seen in credit markets.
Yes, like with First Brands or Tricolor.
Right, where you see allegations of fraud or lending to people with no credit scores.
Right.
That sounds like a systemic problem, like the financial plumbing is broken.
And that's where he makes a really essential distinction. He says these are not systemic failures. The plumbing, the big financial system itself is okay.
So what are they?
He calls them systematic errors.
Okay, what's the difference between systematic and systemic?
A systematic error is a regularly recurring behavioral phenomenon.
So it's human error, not a system breakdown.
Precisely. It means that people are highly prone to error in good times. When money is cheap, lenders get desperate for yield, they lower their standards, they stop doing their homework, and they make bad loans.
Which only get exposed when things tighten up.
This just confirms that old banking adage, the worst of loans are made in the best of times.
That's a great line.
It's a behavioral issue that just always comes back. The system can handle the failure, but human greed creates the mistake over and over again.
So knowing all this, the psychological flaws, the end of easy money, what is Mark's prescription for the average person trying to succeed long-term? What's the easy game?
The easy game is simply to subscribe to the historical base rate.
What does that mean?
The S&P 500 has historically returned about 10% a year. If you had invested $1 at that rate, it compounds to something like $14,000 today. That is the high probability path to success.
And the mistake is ignoring that.
And instead chasing the low probability, high reward outlier, trying to find the next NVIDIA, which usually just leads to failure.
It all comes back to humility.
Absolutely. When you're facing something complex like AI, Marx says the 3 greatest words an investor can say are, I don't know.
That humility forces you to be patient.
And it prevents you from making those huge, costly, emotional mistakes.
He has a great analogy for that patience.
He does. He says, if you stand at a bus stop long enough, you'll probably get a bus. If you run from bus stop to bus stop, you may never get a bus.
Just let your quality assets compound instead of chasing every new headline.
That's the whole game right there.
So if we synthesize everything we've talked about, it feels like there are 2 massive takeaways from Howard Marks.
I think so.
First, price is driven by psychology, by these behavioral extremes, not just by value. So buying well is actually more important than buying something good.
And second, the rules of the financial game have changed. The era of easy money is over, that subsidy is gone, and it demands a return to prudence and careful debt selection.
Okay, here's the final thought from Marx for you to mull over. When you're making any investment decision, you're caught in this constant tension.
What's the tension?
It's that all of your knowledge is with regard to the past, and all your decisions are with regard to the future.
That's a powerful idea.
It is. And that tension demands that you be painfully honest about what you really know versus what you're just hoping for.
So you have to look at the current consensus, whether it's on AI or anything else, and just be skeptical. Because if everyone is certain about a future outcome,
then that outcome is already baked into the price you're paying today.
there's no value left for you.
A great reminder that the search for value really begins with a search for truth, especially inside our own heads. Thank you for joining us for this deep dive into the wisdom of Howard Marks.